Welcome to Fear and Greed, the week ahead. I'm Sean Aylmer, and as always, I'm joined by economist Stephen Koukoulas this fine Monday morning. You'll find him at thekouk.com, THEKOUK.com, and on Twitter using the handle thekouk. Stephen, good morning.
Good morning, Sean.
So much going on in the world of economics. Let's start with last week. National accounts figures. Did you enjoy them?
I did. There was lots of information in there, and when you cut beneath the sort of surface numbers and dig into them, they were actually reflecting a pretty good economy. We know that growth in the March quarter itself was 0.8%, so that was a little above expectations, but a solid result. The annual figure was around about 3.3% growth in GDP. So again, that's a pretty good result. So you can see there quite clearly that the economy was growing and growing quite nicely. The composition of that growth was okay too. We had a very strong lift in household spending, so we consumers are out there spending pretty well. That growth was around about 4% in annual terms. Government demand, so we had maybe this is pre-election stuff, but the government was spending like crazy. It was up 8% in annual terms. So those two parts of the domestic economy were strong. We had a negative from the net export side because we're importing lots of machinery and equipment and these things as the economy recovers, and that subtracted a little bit from bottom line GDP. But overall, a pretty nice, solid result. The RBA and Treasury would be pretty happy with that.
Okay, now just something we Michael and I were talking about this during the week, and so before we get on to the Reserve Bank this week, I just wanted to ask you a question. We're talking about the international trade figures and the current account deficit came out and how economists forecast those massive numbers. And I think in one case, the forecasts were for about, I think it was 10.5 and came in at 7.5 or vice versa, billion we're talking about here. We're just talking about how economists actually do it. And particularly around trade figures and current account figures, how different the actuals can be from the forecasts.
I'm going to expose my colleagues and myself on this one.
None of us can do it. None of us have a clue.
Yeah, look, well, on the trade side, the international trade, current account sort of numbers, there's a lot of moving parts. And this is sort of not to make an excuse, but just to show how we can be so wrong from time to time. Obviously, on the goods side, that is sort of international trade in goods rather than services, we have a fair idea for what the price of a lot of commodities are, the things that we export, so the iron ore price, the coal price, the LNG price, and we have a fair estimate on what the volumes of those particular products happen to be. So we can get them pretty accurate. Where we have problems is on the import side. And, Australia imports a lot of machinery and equipment, chemicals, these sorts of things. And again, we don't really know how many trucks, cars, all the inputs into the business sector that are going on at the moment. We can have a stab and have a look what happened the last few months, what's happened to trends, what's happened to various surveys on what firms are telling us about what their intentions are to spend and invest. You can have a stab at it. But if you get a smallish error on all of the components, they compound into what's a pretty big miss. So that's on the good side. And on the services side, it's very difficult to know what exact tourism numbers are. So people starting to come and go in and out of Australia now. That was another reason why that forecast was a long way from what the consensus view was.
Okay. So big week. Tomorrow, the Reserve Bank meets.
They do, and the only discussion is what sort of interest rate hike are they going to deliver. I think, well, as we're just touching on the GDP numbers, they were nice and strong, so the RBA would be pretty happy with that. We know that inflation pressures are still building, and with those national accounts, actually, Sean, they do have what they call these implicit price deflators, and they're measures of inflation. It's different to the consumer price index because that's the consumer by definition, whereas these price deflators for GDP include a whole lot of other price measures that aren't included in the CPI. And again, they were all very elevated. So RBA board meeting tomorrow, they'll be saying, well, we've got a hike. My hunch is that they'll go bigger rather than smaller. We know that the Bank of Canada hiked last week by 50 basis points to 1.5%. Our friends in New Zealand are already at 2%. All the Fed chatter last week, this week will all be about whether they go 50 and then 50 again at their next two meetings. So my view is that they do err on the side of a bigger rather than smaller move. 40 points takes it to 0.75. So that's a nice sort of on that quarter percent type movements. Yeah. They could easily go 50 and no one would be really surprised.
Okay, so we get that announcement tomorrow afternoon. How important? I mean, we talk so much about rates, but we had a rate hike a month ago, and we talked lots about it, but it doesn't seem to have done that much to the economy yet. Now, I get that it's only 25 basis points. Let's say we get another one of 25 basis points or 40 basis points tomorrow. How long before we really start seeing the economy slowing down?
Yeah, look, we know that I think the official jargon is there's long and variable leads in terms of monetary policy changes and the impact on the economy. That's a way of saying, a bit like our discussion on the international trade numbers, we're not 100% sure how long it takes. But the modelling of that says it's somewhere between 6 and 18 months is normally the biggest impact. So, the first rate hike, as we're saying, was just a month ago. So the effect of that will probably be in the latter part of this year. The transmission mechanism, which is what they call it too, so the rate hike and its impact on the economy is probably shortening. There's also, apart from the effect on our cash flow as the rates go up, there's also a sentiment effect. So you're seeing that somewhat in housing right now. So even though, a quarter of a point last month, probably not going to, hurt the housing market that much. The fact that it's happened, the fact that there are more coming down the track that is causing people just to rethink their borrowing capacity and the like. So my hunch is that we'll start to see the real effects of these rate hikes on the economy, in the third quarter of this year, but also remembering too that there are so many other moving parts in the economy right now. This energy price spike, goodness, the impact on the economy of that's going to be very difficult to read. So there are many moving parts, but the rate hikes themselves, they'll probably start to have their effect in 3, 4 or 5 months from now.
Yeah, I was going to ask, with the cost of living pressures, particularly energy, how much will the Reserve Bank think about that, the Reserve Bank board think about that before making a call?
Oh, look, they'll have it in the forefront of their mind. And in fact, when we see the statement tomorrow afternoon from the RBA, there's no doubt they'll have a good paragraph or so on some of these issues. And they're really difficult to incorporate into any model. They could reverse just as quickly as they've spiked higher, if you know what I mean. If we happen to get some sort of supply side response or the markets settle down somewhat, in a few months' time, we could hopefully be seeing some of these energy prices sort of reverting back to sort of where they were, a few months ago. But while they're impacting and while we're seeing these petrol prices, for example, back above $2, even with that excise cut, that the impact on, again, sentiment and your hip pocket, to be frank, are quite real. And it means that if you're spending more money filling up your car, paying your quarterly electricity bill because you turned your heater on, then you do have less money to spend elsewhere in the economy. And it's actually a contractionary thing on the economy, even though obviously it feeds into much, much higher inflation.
Stephen, enjoy the week.
Will do.
That was economist Stephen Koukoulas, better known as The Kouk. You can find him at thekouk.com and follow him on Twitter using the handle The Kouk. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.